When March 2020 hit and everything shut down, stock markets went into freefall. Then the Federal Reserve made a move they'd never made before. They announced they were going to start buying bonds from private companies. Not the usual government bonds, actual corporate bonds from regular businesses. The Fed was stepping in to rescue private corporations directly. But here's the crazy part that almost everyone missed. The Fed didn't actually do this themselves. They hired an outside company to handle everything. Just one single company. This one firm would get to pick which corporations got saved and which ones didn't. They'd be choosing the winners and losers during America's biggest market rescue ever, that company, BlackRock. And get this, the amount they charged the Federal Reserve? Absolutely nothing, zero. They did the whole thing for free. Now, when the world's most powerful money manager volunteers to work without getting paid, that should send chills down your spine. Because what they're receiving instead of money is worth infinitely more. BlackRock controls $10.5 trillion. That's bigger than the entire economy of every nation on the planet except America and China. They hold stakes in practically every big company you deal with every single day. They're the number one shareholder in Apple, Microsoft, Amazon, Google, JP Morgan, Bank of America, Exxon, and Chevron. I could keep listing companies for hours. But their massive size isn't actually the scary part. The truly dangerous thing is something most people have never even heard about. It's called Aladdin. Aladdin goes way beyond being just computer software. It's a risk management platform that oversees $21.6 trillion in assets. That's literally double what BlackRock officially controls. The world's biggest banks, insurance giants, pension funds, and even governments use it to decide where to put their money. Just one single system, monitoring more than $21 trillion, with the power to glimpse nearly every major trade before anyone makes it. If that sounds like way too much power concentrated in one place, you're absolutely correct. But wait, it gets even more disturbing. BlackRock isn't just moving money around anymore. They're literally rewriting how capitalism works, moving wealth away from regular people owning things to big institutions controlling everything. And they're pulling it off so slowly and carefully that hardly anyone realizes it's even happening. Let me break down exactly how they pulled this off, why it matters to you, and what it means for your future. BlackRock got started back in 1988 when Larry Fink and 7 other partners launched it. But this isn't some feel-good story about a scrappy startup that made it big. This is about a guy who figured out something really important early on. The real power doesn't come from owning stuff yourself. It comes from managing everyone else's stuff and controlling the systems that decide what everything is worth. Larry Fink began his career at first, Boston during the 1970s and 80s. He became one of the early pioneers working with mortgage-backed securities, yes, the exact same financial products that eventually triggered the 2008 collapse. Back in 1986, his mortgage securities division lost $100 million because he didn't see interest rate changes coming. They pushed him out, but losing all that money taught him something incredibly valuable. Whoever controls risk management controls the entire game. When he started BlackRock in 1988, he wasn't building just another investment company. He was creating a tech company that happened to handle money. The main product wasn't investment tips. It was a risk management platform that could predict how investment portfolios would perform under different scenarios. They named that system Aladdin, which stands for Asset, Liability, Debt, and Derivative Investment Network. During those early years, BlackRock sold Aladdin's risk analysis services to other financial companies. Banks and investment managers would pay BlackRock to examine their portfolios and explain how much risk they were actually taking. Stop and think about what that really means. BlackRock could look inside their competitors' investment portfolios. They knew exactly what other institutions owned and what they were planning to sell. It's like sitting at a poker table where you can see everybody else's cards. By 1999, BlackRock was managing $165 billion. Pretty impressive, but not dominating the market. Then they went on an acquisition spree that completely changed the game. In 2006, BlackRock merged with Merrill Lynch Investment Managers, instantly adding $1 trillion to what they controlled. In 2009, right after the financial crisis hit, they bought Barclays Global Investors for $13.5 billion, which brought in another $1.5 trillion in assets, and this is crucial, gave them control of iShares, which is the world's biggest ETF platform. These weren't just regular business acquisitions. They were infrastructure takeovers. ETFs, exchange-traded funds, are how most regular people invest nowadays. Instead of buying individual company stocks, you buy an ETF that owns hundreds of different stocks. The ETF provider BlackRock, through its shares, gets to vote those shares in all those companies, even though the investors don't even know they've given away their voting rights. By 2010, BlackRock controlled $3.5 trillion. By 2020, that jumped to $8.7 trillion. Right now, in 2026, they're at $10.5 trillion. But that number doesn't tell the whole story. Because of Aladdin, BlackRock's actual influence reaches way beyond what they officially manage. As we speak in 2026, more than 240 financial institutions use Aladdin for managing risk. These institutions combine control over $21.6 trillion in assets. Every single day, Aladdin processes 250 million trades. It analyzes risk for pension funds, sovereign wealth funds, central banks, insurance companies, and major banks. BlackRock doesn't just see what they personally own. Through Aladdin, they see what everybody owns. And here's where things get really wild. When crisis hits, governments don't call university professors or policy research groups. They call BlackRock. Back in 2008, when Bear Stearns fell apart, the Federal Reserve hired BlackRock to analyze Bear Stearns' assets and figure out what they were actually worth. When AIG exploded, the Treasury brought in BlackRock to value their assets. When the Fed needed to unwind its mortgage-backed securities portfolio after quantitative easing, they hired BlackRock. In March 2020, when the Fed decided to buy corporate bonds for the very first time, they hired BlackRock to choose which bonds to purchase, execute the buying, and manage the whole portfolio. BlackRock basically became the U.S. government's outsourced investment management department. And remember, they did all this without charging a single dollar, zero fees. Why would they do that? Because what they received in exchange was way more valuable than any fee. They got early access to information about government policies. They got to influence which companies received bailout funds. They got to position their own funds before these interventions became public knowledge. They gained credibility as the firm governments turned to during emergencies. The real value of that kind of access? Impossible to calculate. But the biggest wealth transfer isn't happening through bailouts and crisis management. It's happening through something much quieter. The systematic shift from regular people owning things to institutions owning everything. Here's how they're doing it. After 2008, BlackRock identified housing as the next big asset class to turn into financial products. Not commercial real estate that was already controlled by institutions. Residential housing, single-family homes. The actual houses where families live. In 2012, BlackRock invented a new asset class they called single-family rental securitization. They packaged rental homes into financial products, just like mortgage-backed securities, and sold them to investors as a brand new investment category. At that time, it seemed like just a niche strategy. Some investors were buying foreclosed properties, renting them out, and making money, no big deal. But then look at what happened after March 2020, between April 2020 and December 2021. Investment firms purchased more than 574,000 single-family homes across the United States, not to fix and sell them, not to live in themselves, to rent them out permanently. Who were the biggest buyers? Invitation Homes, American Homes for Rent, Progress Residential, and who owns the largest shares in these companies? BlackRock, Vanguard, and State Street. In cities like Phoenix, Atlanta, Charlotte, and Jacksonville, institutional investors now own more than 20% of all single-family rental homes. In certain zip codes, they own over 40%. Here's why this is a massive problem. When institutions buy homes at this scale, regular families can't compete. An algorithm with instant financing approval will always beat a family that needs to get a mortgage approved. When institutions control rental housing at this scale, they can coordinate price increases across entire markets without technically colluding. The outcome? Home ownership rates for Americans under 40 have crashed from 43% in 2005 to just 37.2% in 2026, not because young people don't want homes, because they're systematically getting outbid by institutions with endless amounts of capital. And those institutions are funded by pension funds, insurance companies, and retirement accounts that use Aladdin for risk management and invest in BlackRock ETFs. You're literally funding your own displacement. But housing is just one piece of the puzzle. The bigger transformation is happening in corporate ownership itself. Right now, in 2026, BlackRock, Vanguard, and State Street combined control approximately $22 trillion in assets. Through their ETF platforms, they're the largest shareholders in 88% of S&P 500 companies. This creates something that's never existed before in capitalism common ownership. When the same three institutions own major pieces of every airline, they have no reason to compete on price. When the same three own major stakes in every pharmaceutical company, they have no motivation to lower drug prices. When they own major stakes in every media company, they have no incentive to promote different viewpoints. Their goal is to maximize returns across all their holdings, which means encouraging cooperation instead of competition. Academic studies have actually proven this. Research from Harvard, MIT, and the University of Michigan shows that industries with high common ownership have higher prices, less innovation, and lower worker wages compared to industries with spread-out ownership. The airline industry is the perfect example. Between 2010 and 2018, ticket prices jumped 23% while service quality got worse. During that exact same time frame, common ownership by BlackRock, Vanguard, and State Street increased from 18% to over 35% of the entire industry. Coincidence? Or rational profit maximization when you own all the competitors? But the method BlackRock is using to reshape capitalism goes beyond just ownership stakes. It's something called ESG, environmental, social, and governance investing. On the surface, ESG sounds great. Companies should care about environmental impact, social responsibility, and good governance practices. Who could possibly argue with that? But look at how it's actually being used. BlackRock controls the world's largest ESG funds. They pressure companies to adopt ESG policies by threatening to vote against management if they refuse. And because BlackRock controls voting rights for millions of passive investors through ETFs, company management has no choice but to listen. But here's the critical question nobody's asking. Who gets to define what ESG actually means? Who decides which behaviors are good and which are bad? BlackRock does, along with a tiny number of other massive institutional investors. It's not democratic. It's not passed by Congress. It's not voted on by citizens. A handful of asset managers are essentially creating global policy without any public accountability whatsoever. Larry Fink writes an annual letter to CEOs that gets treated like a decree from the Pope. In his 2021 letter, he told companies that climate risk equals investment risk. In 2022, he said capitalism must be reimagined. In 2024, he declared companies must serve all stakeholders, not just shareholders. Notice the progression? We went from invest responsibly to redefine capitalism in just 3 years, and here's where it gets really sinister. ESG policies consistently benefit massive corporations and hurt small ones. Carbon reporting requirements. Easy for ExxonMobil with their 1,000-person compliance team. Impossible for a small trucking company, diversity quotas. Easy for Google with HR departments in every office. Really difficult for a family-owned manufacturing business. ESG creates barriers that protect large corporations and eliminate small competitors, and those large corporations? Owned by BlackRock. This isn't an accident. It's the predictable result when the same institutions own everything and use that ownership to write rules that benefit themselves. Now, let's talk specifically about the Aladdin system, because this is where BlackRock's power becomes genuinely dangerous. Aladdin doesn't just analyze risk. It actually shapes reality. When 240 institutions managing $21.6 trillion all use the exact same risk model, they all see risk the exact same way, they all respond to risk the exact same way, they all buy and sell at the exact same time. This creates systemic fragility disguised as safety. In 2020, when COVID hit, every institution using Aladdin saw the same risk signals and sold the same assets all at once. That's part of why markets crashed 34% in just 3 weeks, the fastest decline in history. Then the Fed announced intervention, Aladdin's models updated, and everyone bought simultaneously. Markets recovered to new record highs within 6 months. Was this a healthy market response? Or was it algorithmic herding coordinated by a single system? Even more concerning, because Aladdin sees trades before they're executed, BlackRock theoretically has advanced knowledge of major market movements. Not insider trading in the legal sense, they're not trading on company-specific information, but they're trading on market structure information that nobody else can access. It's like if one chess player could see every move every other player was planning before they made it. BlackRock will tell you they have Chinese walls, compliance systems, and ethical guidelines preventing misuse. Maybe that's completely true. But the structural advantage exists whether they exploit it or not. And history shows us that when systemic advantages exist, someone eventually exploits them. Now let's examine BlackRock's relationship with government. Because this is where private power becomes impossible to separate from state power. Larry Fink has unmatched access to policymakers. BlackRock executives constantly rotate into government positions. The company's former employees hold positions at the Treasury, the Federal Reserve, the Council of Economic Advisors, and the National Economic Council. In 2021, Brian Dees, BlackRock's former global head of sustainable investing, became director of the National Economic Council under President Biden. In 2022, Adewale Ademo, former senior advisor to Larry Fink, became Deputy Secretary of the Treasury. This kind of thing isn't unusual in finance. Goldman Sachs has been doing this for decades. But BlackRock's revolving door is different because BlackRock isn't just one bank. They're the infrastructure underlying all banks. When government officials come from BlackRock, are they serving the public or BlackRock's interests? And when those interests align, which they often do because BlackRock owns pieces of everything, how can you even tell the difference? Think about what happened in March 2020. The Fed hired BlackRock to buy corporate bonds. Which bonds did BlackRock choose to buy? Conveniently, many were bonds from companies where BlackRock's own ETFs held large positions. BlackRock used government money to buy assets that increased the value of BlackRock's own funds. They claimed this was just coincidence. They own pieces of most large companies, so any corporate bond program would naturally overlap with their holdings. Maybe that's true. Or maybe it reveals the deeper problem when one institution is so enormous that conflicts of interest become meaningless because their interests are everyone's interests. We've moved beyond capitalism into something completely different. Some people call it corporatism. Others call it stakeholder capitalism. Some call it neo-feudalism. Whatever label you use, it's a system where you don't own assets anymore. You rent access to assets owned by institutions. You don't own a home. You rent from invitation homes. You don't own stocks. You own ETF shares that give BlackRock voting control. You don't own your retirement security? It's managed by a system that prioritizes institutional returns over your individual financial security. This is the world BlackRock is constructing, and they're not even hiding it. At the 2016 World Economic Forum, there was a promotional video with the message, "You'll own nothing and be happy." Klaus Schwab didn't dream up that vision by himself. It was developed in partnership with institutions like BlackRock, who were already putting it into action. Own nothing, rent everything. Let institutions manage all the assets. You just pay subscription fees for access to housing, transportation, food, entertainment, and eventually healthcare, education, and everything else. That's not conspiracy theory. That's their openly stated vision being implemented right now. Now let's connect this to historical patterns, because this exact transformation has happened before in history. In feudal Europe, peasants didn't own land. They worked land owned by lords. They paid rents, tithes, and taxes for the right to use resources they could never own. Social mobility was impossible because you couldn't accumulate capital. You only had access to capital controlled by the aristocracy. The shift from feudalism to capitalism happened when land ownership became accessible to non-aristocrats. The enclosure movements, controversial as they were, at least created the possibility of ownership for common people. For 300 years, capitalism meant you could actually own things. Buy a farm, you own it. Start a business, you own it. Buy a home, you own it. Build wealth through ownership. Pass it down to your children. That ownership was never universal. There were always wealthy elites who owned more, but the possibility existed. You could, through hard work and saving money, accumulate ownership. What BlackRock and institutions like it are doing is reversing that 300-year trend. We're going back to a world where ordinary people don't own assets. They rent access to assets owned by a new aristocracy of institutional investors. The difference from feudalism is that the new lords aren't individual nobles. They faceless institutions managed by algorithms and controlled by a financial elite that's even more concentrated than medieval aristocracy ever was. At least in feudalism, there were hundreds of lords with competing interests. In this new system, there are three firms, BlackRock, Vanguard, and State Street, that own everything. And unlike feudal lords who were tied to specific geographic areas and therefore somewhat accountable to local populations, these institutions are global and accountable to absolutely no one. Here's who comes out ahead in the BlackRock system. Institutional investors, pension funds, endowments, sovereign wealth funds, ultra-wealthy individuals who can access alternative investments. They get the returns from asset appreciation and rental income. The top 10% of wealth holders own 89% of all stocks in America. BlackRock's model concentrates returns even further into that top 10%. Larry Fink himself is worth an estimated $1.2 billion. BlackRock executives and shareholders capture enormous wealth. The institutions that use Aladdin get informational advantages. Here's who loses in this system. Anyone who expected to build wealth through ownership. Young people who can't buy homes because institutions outbid them every time. Workers whose companies prioritize ESG metrics over fair wages. Small business owners who can't compete with corporations that have access to unlimited capital from asset managers. Anyone who thought capitalism meant you could work hard, save money, buy assets, and build wealth to pass down to your kids. That model is dying. BlackRock is killing it. And they're doing it with your money. Your 401k, your pension, your retirement account. It's being used to fund the very system that prevents your children from ever owning anything. Now here's what should absolutely terrify you. BlackRock isn't finished. Their next target is infrastructure. In 2021, BlackRock launched a $12.5 billion infrastructure fund. They're now bidding on water systems, toll roads, electrical grids, ports, and telecommunications networks. The essential systems that society depends on are being privatized and purchased by institutional investors. When BlackRock owns your city's water system, electrical grid, and toll roads, you don't just rent your home from them. You're renting access to civilization itself. This is already happening right now. In 2023, BlackRock's infrastructure funds acquired stakes in water systems serving 14 million Americans. In 2024, they bought controlling interests in renewable energy grids across 5 states. In 2025, they partnered with the Department of Transportation to acquire and operate toll road systems. Public infrastructure built with taxpayer money over decades is being sold off to private investors who will charge fees forever. The government calls this unlocking value and improving efficiency. What it actually means is converting public goods into private profit streams. And here's the mechanism that makes this inevitable. Governments are completely broke. Federal debt is $35 trillion. State and local governments have $1.4 trillion in unfunded pension obligations. They desperately need money right now. BlackRock shows up with cash offers. Sell us the water system. We'll operate it efficiently. You get money today, we get revenue streams forever. Desperate governments take the deal. And regular citizens end up paying institutional investors for access to resources that used to be public goods. This is the endgame. Total institutional ownership of everything essential. Housing, infrastructure, energy, food production, water, transportation. You'll own nothing. BlackRock will own everything. And you'll rent access at whatever price maximizes their return. So what can you actually do about this? First, understand what's really happening. Most people don't even know BlackRock exists, much less what they're doing. Awareness is step one. Second, look at where your retirement money is actually invested. If it's in ETFs, especially iShares ETFs, you're funding BlackRock's agenda. You can't completely avoid them because they own pieces of literally everything, but you can minimize how much control you're handing over to them. Third, prioritize actual ownership over convenience. Buy a home if you possibly can, even if renting seems easier in the short term. Buy individual stocks if you understand them, even if ETFs seem simpler. Own real assets, land, equipment, businesses, anything they can't turn into financial products. Fourth, support policies that break up institutional concentration. Antitrust enforcement against common ownership. Restrictions on institutional investors buying residential real estate. Transparency requirements for Aladdin and similar systems. But here's the brutal truth. Individual action isn't enough to stop this. BlackRock's advantage is structural. They've built the infrastructure of modern finance. Dismantling that requires political will, regulatory courage, and massive public demand for change. And right now, most people don't even realize there's a problem. That's completely by design. BlackRock doesn't want attention or scrutiny. They want to quietly accumulate control while everyone focuses on other issues. The transformation from ownership capitalism to rental feudalism is happening silently, gradually, one asset class at a time. By the time most people notice what's happened, it'll be complete and irreversible. You'll wake up one day and realize you own nothing of real value. Your home is rented. Your retirement is managed by institutions you don't control. Your job serves corporate interests shaped by ESG mandates. Your choices are constrained by infrastructure owned by asset managers. And you'll have nobody to blame because you never saw it coming. Rome didn't collapse in a single day. Britain didn't lose their empire in 1 year. And capitalism won't die in some dramatic revolution. It'll die quietly, replaced by something that looks like capitalism on the surface, but actually functions like feudalism, where assets are owned by institutions, controlled by algorithms and managed for the benefit of a concentrated elite. BlackRock isn't evil. They're rational actors maximizing returns within a system that allows and even encourages their behavior. But the system they're building is one where you will own nothing, where institutional control replaces individual ownership, where wealth concentrates among the financial elite while everyone else rents access to assets they can never own. That's not conspiracy theory. That's their explicitly stated vision. And they have $10.5 trillion in assets, $21.6 trillion under risk management, and unlimited access to government power to make it a reality. The question is whether enough people will notice in time to stop it, or whether we'll just accept rental feudalism because it arrived so gradually we never even realized. Ownership was slipping away from us.